Hello guys, and welcome back to Trade to Learn. This is the second part of our crypto series. So if you haven't already, go ahead and watch the first video, the link's in the description. The underlying ledger tech for cryptocurrencies is blockchain. So today, let's go deeper into understanding it. So, we briefly said that blockchain is a technology that's used to organize ledger in the last video. In this video, we're going to go a lot deeper. But before that, let's define a few common terms. First off, a distributed ledger. It's pretty much a system for recording payments, where the transaction and its details are recorded on multiple places at the same time. And this is what blockchain is based off. Next is a fork. The strength of the public blockchain network lies in the 100% democratic nature. Everything is decentralized and everyone has the same information. No individual is above another. But if everything is decentralized and everyone has to agree on every single change, you won't really be able to change anything or improve anything. And if you centralize in part, that attacks the very foundation of blockchain. So, when one part of the users want to change something and they encounter the opposition, this results in the impossible situation of finding a unanimous position. And that's how forks are produced. Some examples are when Ethereum had a hack and it split into Ethereum and Ethereum Classic, or when Bitcoin split into Bitcoin and Bitcoin Cash. Forks are pretty much variations of a currency. Last but not least is a node. And a node is pretty much a computer that's part of a crypto network. Each time a block is added to a general ledger, a copy is also added to all of the nodes in the network. Now that you know these terms, let's get into what blockchain really is. Blockchain is a distributed ledger that records transaction data, and it's very hard to tamper with. And here's why. So let's take a look at what a block is and what it includes. Each block contains some data, the block's hash and the previous block's hash. In Bitcoin, for example, the data shown is who sent the money, who received it, and how much was paid. A block's hash identifies its block and its contents. It's also unique, like a fingerprint. So when something in the block changes, the hash changes as well. This is why hashes are very useful to detect changes in blocks. The last thing is the block of the previous block's hash. This is what creates the chain and what makes it so secure. For example, here are 3 blocks and each block has its hash and the previous block's hash. So block 3 points to block 2 and 2 points to block 1. The first block is different. It can't point to anything as it's the first block. This block is called the genesis block. When the block changes, the hash changes and then the hashes don't match anymore, making all the next blocks invalid. As I said in the first video, everyone on the network has a copy of their ledger. This is called a P2P network or a peer-to-peer network. When someone joins the network, they get a copy of the ledger. When a new block is created, it's sent to everyone's ledger, and once it's verified, it's authenticated. Majority of all cryptos use the distributed ledger blockchain. It's revolutionized the way transactions are stored. With more and more cryptos adopting its secure tech, blockchain is something to look at both now and in the future. That was all for today. This was part 2 out of 4 in the series on the basics of cryptocurrency. In the next part, we'll dive into crypto mining. Make sure to leave a like to help with the YouTube algorithm and subscribe so that you don't miss any new videos. Also, go ahead and check out our Stocks Basics playlist if you haven't already.